On this video of the Bedroom Investor Stock Valuation series, we will be discussing what is the price-to-cash flow ratio and how we can use it to value the stock of a company. The price-to-cash flow ratio is a valuation metric and is a powerful tool that is used by investors to help them value a stock. The price-to-cash flow ratio is calculated by dividing the share price of a company by the company's operating cash flow per share. Investors use this metric to help them determine whether the stock of a company is over or undervalued. The price-to-cash flow ratio measures how much cash a company generates relative to the price of the stock. The price-to-cash flow ratio is a ratio in which the lower the number, the better, because it means the stock is cheaper. And a prospective investor of the company has a chance to pick up shares of the company at an undervalued price. The price-to-cash flow ratio is believed by some investors to be a better valuation metric compared to the price-to-earnings valuation metric. This is because the cash flows of a company cannot be as easily manipulated by management like the earnings of a company can. The price-to-cash flow ratio also tells us how much investors are willing to pay for each dollar of cash flow that the company generates. A price-to-cash flow ratio of 5 means that an investor is paying $5 for every dollar of cash flow. There are two methods for calculating the price-to-cash flow ratio. The first method is the per-share method, where you divide the share price of the company by the company's operating cash flow per share. The second method is the market cap method. This is where you divide the market cap of the company by the company's operating cash flow. Let's look at the price-to-cash flow ratio equation in more depth, especially the denominator section of the equation. The operating cash flow per share. To help us understand the price-to-cash flow equation, we will use the hypothetical coffee shop, Anne's Coffee Shop. Anne's Coffee Shop takes in revenue from selling coffee, and Anne's Coffee Shop has her normal business operating expenses. To calculate the operating cash flow for Anne's Coffee Shop, we must subtract the operating expenses for Anne's Coffee Shop from the revenue her shop generated. Let's say that Anne's Coffee Shop generated revenue of $10 million and had operating expenses of $2 million, and plugging these numbers in the equation and computing it gives us a value of $8 million. So in this case, Anne's Coffee Shop had an operating cash flow of $8 million. Next, for us to then calculate the operating cash flow per share for Anne's Coffee Shop, we simply then divide the operating cash flow, which is $8 million, by the number of shares outstanding of Anne's Coffee Shop, which is 1 million shares. The calculation computes to be $8, and in this case, Anne's Coffee Shop had an operating cash flow per share of $8. Let's look at the two methods for calculating the price-to-cash flow ratio. Again, we will consider the hypothetical coffee shop, Anne's Coffee Shop, which has generated revenue of $10 million, has operating expenses of $2 million, 1 million shares outstanding, and a share price of $25. The per-share method for calculating the price-to-cash flow ratio is where you divide the share price of the company, which in this case is $25, by the company's operating cash flow per share. We have already previously calculated the operating cash flow per share of Anne's Coffee Shop, which is $8, and plugging the numbers into the equation and computing it gives us a price-to-cash flow ratio of 3.12. The second method for calculating the price-to-cash flow ratio is the market cap method. With this method, we will divide the market cap of Anne's Coffee Shop by the shop's operating cash flow. To calculate the market cap of Anne's Coffee Shop, we simply multiply the share price of Anne's Coffee Shop, which is $25, by the number of shares outstanding, which is 1 million. The calculation is $25 million. The operating cash flow for Anne's Coffee Shop, again, we have already previously calculated, was $8 million. Plugging the market cap and operating cash flow into the equation and computing it gives us a value of 3.12 for the price-to-cash flow ratio, the same value we calculated using the per-share method for the price-to-cash flow ratio. By the way, for more information on the market cap, click on the link in the top right-hand corner of the video, or click on the link in the description below. Let's answer an important question, and that is, what is a good price-to-cash flow ratio? Well, the answer to this question is that it depends in which sector the company you are looking at is in. A new and rapidly growing technology company, for instance, may trade at a much higher price-to-cash flow ratio than a utility company that has been in business for decades. The technology company may have only small profits to begin with, but investors will be willing to give the company a higher valuation compared to the utility company because of its higher prospects for growth. On the other hand, investors will more likely give the utility company a lower valuation because although the company has stable cash flows, it has fewer growth prospects. It is up to the investor to do his or her due diligence on a company to figure out if the price-to-cash flow ratio a company is trading at is justified, or if it may be over or undervalued. We hope you found this video useful, and thank you for watching. Don't forget to subscribe to our channel so you can receive notifications of our new uploads.